Louisa from Mesh, Ayanda from a extraordinary business that does very, very cool things, and Pete from a business that challenges conventional thinking. Let's start with you, Pete. I don't know who wins the shoe prize this morning. I don't think it's you and me, Louisa.
No,
I think we are
not. I didn't get the memo, Ed.
Yeah, we bronzes. Gold and silver.
I think I've got a silver here. I've got a silver.
Yeah. You get the silver. All right. So as the silver medalist in the shoe prize, let's start with you, Pete. You build a portfolio that essentially prepares for what I'll term a nuclear winter, a financial winter. Maybe nuclear is too grand, but certainly a financial winter. And you give it a very animated name. We were challenged by the school in being able to use this name in inviting people to this morning's event. You call it the cockroach.
Yeah.
You try and get that through business school marketing.
So at least everybody will remember the name cockroach. I mean, that's point number one.
Okay.
Yes.
So it is a fund that like a cockroach can survive. Well, a cockroach is said to be able to survive a nuclear fallout type event or a financial meltdown. But not only that, cockroaches also thrive when the going is good. So it's both.
Okay.
It aims to thrive when conditions are suitable, and it aims to survive when conditions are adverse. So its point of departure is to enable investors to stay in the game. Because over time, equity markets do well. I mean, equity markets and even bond markets, over time they do fine. But they do well in a scary way. There's lots of volatility along the way. So over the long term, the JSE has done 6% real, which is a fantastic return. If you can compound your capital in real terms by 6% per annum, you will have done fantastically well. But every couple of years, there's a massive sell-off, which scares everybody, and they want to get out the market at that time. So what I'm trying to achieve with the cockroach is when that nuclear event happens, that you don't get scared and leave the market. Because as I think it was Morgan Housel said, if you can compound at average returns for an extraordinary period of time, long period of time, you'll achieve exceptional outcomes. So the trick that I'm trying to play on investors here is to not scare them and to keep them in the game. And that is the point of departure of the cockroach, because I think if you can generate decent returns, not win the investment stakes, as the consultants and the actuaries and the DFMs, like to set us up against each other. This month that fund did the best, and next month that fund did the best, and over 2 years this fund has done the best. You don't want to win those games. The game you want to win is the game of staying in the game over time.
So is the cockroach known amongst his friends and family as Steady Eddie?
That's it, yeah. That's exactly
Okay.
what one is trying to achieve here.
And then, Pete, briefly, we'll come back to this. If what you're describing is an alternative approach, at least in one breath. In the second breath, does that alternative approach then have inside of it alternative assets?
Yeah. So it's an alternative, you're 100% right. It's an alternative approach to investing, moving away from games you can't really win and games that are set up by other people for their own purposes to a game which is to your benefit. So that's an alternative, very alternative approach to what is happening in investing generally. Within the fund, there are some alternative investments and there are some vanilla investments. So it's a mix of those things. As you're talking through this, you remind me of Charles Ellis's book, Winning the Loser's Game. Yeah. That's it, exactly. Yeah.
I've
got a signed copy of that book, by the way.
Oh, nice.
By Charles Ellis.
Wow. Okay.
So that is one of the that book is one of the founding principles of how I invest.
Did you have to say that? Ayanda, if we think about alternative assets going into a portfolio, things that come to mind start with precious metals, commodities, things that behave a little bit differently. We can quickly become a little bit more exotic, and we can put in timber, real estate, maybe a step more, and we can start putting in shoes, handbags, watches, art, wine, whiskey, vehicles. Maybe one step further, and you can start putting in livestock.
Yep, that's 100% correct. So SV Capital is founded on the ethos that an investment can be backed by a real asset. And when we started the business, and I'll actually quote what happened that shaped the journey of SV Capital. When we started the business, so my co-founder and I, Kagiso Tlobatla, we both ex-investment bankers. And naturally, the way we think is structured products, very sexy things. And when we sat with a potential investor at that time, and it was a stockful, and we pitched these sexy products, they said to us, listen, this is all good and well, but we don't understand this. When are we going to get to a point where investments are actually linked to real assets, where we are physically contributing to key sectors? And that's how we came about the cattle investment. So,
No,
yeah.
so maybe, would you mind just saying 2 or 3 sentences about what does SV stand for?
SV stands for democratizing investments and making them accessible, affordable, and looking to change the alternative investment landscape.
And the first assets that sit behind SV Capital?
It's the cattle investment. That's our flagship product. So
Okay.
that's the one product where a lot of people feel like they can resonate with it. And I remember there's always the discussion around there's alternatives and then there's alternatives. And with the cattle investment, we've taken it there. So we've moved away from focusing on alternatives, which are stock standard, that being gold and precious metals and all of that. That feels safe. But as soon as you go the route of cattle investing, now you're bringing investment to the production asset, to the underlying farm, and you're not only generating a return on the funds that you've invested, but you're supporting key businesses that grow our economy.
And what is unmistakable in your business is the first term that you use, which is the democratization.
100%. So that's the key.
Say a tiny bit about that, because I don't have to buy a whole cow, right?
Well, no, you don't. So democratization, and maybe that's a key thing to address. So when we say cattle investment, it's not you owning one physical cow and we drop it off at your address. Adrian, I don't know how you would have felt if we dropped off a cow at your address.
We could have brought it together. It's fine.
Depends, you know.
Grass.
As biltong.
But really the goal was to club together a group of investors and use that capital to acquire a herd. Now, what we've applied is the concept of fractionalization, and that comes down to owning a fraction of the herd as opposed to the whole cow, and that has its advantages. So from a risk perspective, if one cow dies and you own it, that's your entire investment gone. But through fractionalization and you're investing in a herd, if one cow's die, you still have a lot more standing on the farm, which protects your investment in itself. So with us democratizing investment, the goal was to club together or club investors together and utilize their capital to invest in a herd of cattle.
So it's tangible, it's diversified. You're giving me a portfolio
Yep.
of cows.
Mm-hmm.
And it will generate real yield because if our cows are properly fed and well cared for, each time they cross the scale, they will do what the rest of us are trying not to do.
That's correct. So that's how the return is driven. So it's based on the weight gain of that cow. So, you know, the beauty about the cattle investment is that the returns are not on a spreadsheet somewhere, determined by some analyst sitting in a corner somewhere in the office, but they're literally driven by the physical movement of the cattle on the farm. So the farmers we work with, they take over the entire process. from procuring cattle to feeding them, to growing them, and then selling them off to an abattoir for processing. So for an investor, it becomes very simple to understand how you're actually making your money, because when we started our business in 2017, that was the biggest hurdle. A lot of investors didn't understand how they're making their money when investing on the JSE or investing in global markets. You put your money in that hole and you hope for the best. And if any president, and Trump specifically, if he says something, there was a knock-on
We made
effect.
19 minutes.
There was an impact on your portfolio. But with the cattle, we circumvent all of that because the return is driven by the physical movement of that asset and the physical growth of that asset. So you as an investor get comfort in knowing that there's a process and how your return is actually generated.
So, somewhere in here there's a cartoon which might be funny for us, but not the cow, with the cow, a scale, a farmer, an investor going on in my head. But the point that you underline, again, to go back to your opening observation, was it is about democratizing access to real assets, tangible. We understand how the asset produces a yield. Louisa, you get a little bit more exotic in this, in that you stay with the access. You are building extraordinary things at Mesh Trade, but it's a combination now of, if we could put these two terms in the pot, access and alternative.
Yes. So, Adrian, Mesh is a business that was built off a serious problem statement that we saw in the market, which is traditional markets are opaque, they're expensive, they're time-consuming, and you have to have a seat at a very sort of significant table in order to gain the access that you're talking about. So, we truly believe that whereas that world was built for institutions, the future of investing and capital and financial markets really is about participation, broader participation. So the markets should be easy to access, they should be much simpler to engage with and use, and they should be transparent, because transparency creates so much value in terms of access, liquidity, utility, etc. So, I mean, we have built an end-to-end digital capital markets ecosystem where the entire process of the markets, from asset issuance and tokenization, to primary and secondary market trade, to settlement and life cycle management of the asset over its entire lifetime, happens in this one single elegant flow, all on the blockchain, to make it efficient, cost-effective, and value additive. If you look at the stats, since 2000s, the early 2000s when you and I first met, is, sorry, I said I wouldn't say it, is that generally what's happened is public markets have declined. The number of companies that are actually listing publicly has declined by about 43%. And at the same time, investment in private markets and private assets has increased. But the problem with the private markets is they really are, as difficult as the public markets are, they're even harder.
They're illiquid, murky.
Exactly.
Yeah.
And getting access to information, to data, the liquidity, the ability to really get out of a trade once you're in a trade. They're all of those things that are difficult.
So are you fixing that?
So we've built specifically. We are cross-asset. We have on our platform we have some listed funds. We have equities. We have debt instruments. We have commodities like gold.
Could you give
and
us an
silver.
example like your reverse yield?
So that's really an interesting
Reverse
one.
mortgage, sorry.
Yes. So I'm going to talk more generally about property, if that's okay for you, because essentially it's not necessarily about the specific instrument, but it's about the category and the market demand around that instrument.
Right.
So we have we created, Adrian's referring to a preference share, which is a form of equity, but it has different sort of rules, etc., when it's issued for a company that was helping retirees to get equity out of their paid-up homes in order to live, more comfortably, stay in their home. And at the time, preference share was an asset class that company really liked. We've come across one or two other companies in the market who are looking at that, and we found that the demand wasn't there for that specific asset class, but the demand was there for the category, the property category. So we've had a couple of other really, really interesting private commercial property developments that have come in with a pure equity play, where they've said, we have a range of investors who've already taken up this asset. There's a beautiful, beautiful premium asset in Stellenbosch. There's some student accommodation that we're dealing with. We're dealing with property across a range of assets, but generally pure equity, where you're actually benefiting both from the long-term increase in value as well as from the income that is generated, very similar to cattle, has become something that's more attractive to investors than not.
The reason why I was pushing on this reverse mortgage idea is, I think it evidences, well, first it's unique.
Yes.
In a South African context, but second, it evidences what is lost in so many discussions about investing. And Ayanda, you've already made the point, but let's push it a little harder. Is it has impact? It solves a social problem.
Correct.
And so the reverse mortgage allows a person who has full equity in a home to put that home into a portfolio and slowly take capital out whilst they can live in the home that they have always lived in, and ultimately they will die in that home, but allows them to have sort of dignity and access to capital in late stage of life without being forced out of their property. So really, really a high impact product.
Exactly.
And what each of these, certainly what the two of yours do, you haven't convinced me yet, Pete, but what the two of theirs do is they behave differently, which is the first thing we mean by alternative.
Yes.
So just to jump in there, Adrian, so you touch on a key point, that alternative goes beyond just something different. It brings something more to the table. And the more for us is the impact portion, where we found that a lot of investors want to feel like their rand is going beyond generating that return. And when we've had these discussions, the key driver for why investors give us money is the fact that over and above them generating a return, they're also seeing the impact that their capital is doing on a day-to-day basis. And our model actually emphasizes the fact that retail investors now become the key players in growing the economy. So over and above impact, investors are looking at, how do I participate? How do I do my bit? And I think alternatives are moving in that direction to give investors the ability to participate in sectors they wouldn't have access to, but also to focus on the impact leg of it. So what is my money doing to ensure that the next person or the next grouping is benefiting, or their lives are better or easier in any which form? So with SV Capital, through all our products, we're creating jobs. So on the farm, through increased investments, you've got more jobs. Through our delivery bike investment, you're creating jobs in an informal sector that is growing rapidly and no one understands, but it's here and we need to accommodate it. So I think that conversation becomes very prevalent when looking at alternative investments.
So the finance into the delivery bikes that now dominate the streets of South Africa sit with SV Capital. This is one of their investment products. You'll talk a little bit more about that.
Yeah.
Let's come back to that in a sec. Pete, if I could come back to you, building a portfolio is one thing. Building a portfolio that is resilient is a different matter. If we take the conventional approach, it adopts 60-40 is the way the world has worked, or if you want to be a little bit more aggressive, you can do 70-30. We've got lots of finance minds in the room. So we understand this territory well. You are hinting that 60-40 is dead. Or maybe not dead, dangerous.
Yeah, I think it's not dead. I think 60-40 is alive and well, and it's alive and well because that is how things are done. That's just
So alive and well and dangerous?
I think it's dangerous. I do think that based on the past 20 or 30 years of financial history, a 60-40 portfolio, 60 equity, 40 bonds, looks fine, has done well. But I think there is a chance, and this is not a forecast because I hate forecasts, but there is a chance that the correlation between assets like bonds and equities can change over the next 5 to 10 years.
But they did that spectacularly in fairly recently, 23.
22, 23, they
Yeah.
did. They became positively correlated. I mean, the reason why people go for a 60-40 portfolio is because bonds and equities historically have been negatively correlated. So when one goes up a lot, or when one goes down a lot, the other one goes up, and vice versa, and you have a good outcome on average. But when these two big asset classes become positively correlated, as it did in that time when the US bond market went from effectively 0 yields to 4% yields, equity markets went down and bond markets also went down, and the 60-40 portfolio did really badly. And I think that was a sort of a portrayal of what's to come. Possibly.
And those drawdowns are where people panic, they exit,
Exactly.
and then they kill the compounding machine that Morgan Housel refers to.
And you exit the market at exactly the wrong time because you're scared. And that's understandable emotion. So again, what the cockroach is trying to do is take the scare out of the returns. And the way to do that is to be robust to any potential future outcome. Because the one thing we do know for a fact is that we don't know anything. We don't know what the future holds. We probably don't even know what happened in the past properly. So with that point of departure, the only way to deal with that is through a process of radical diversification. Have different types of assets, not only potentially positively correlated assets like bonds and equity, but also alternative assets, hard assets, and cash. And within those asset classes, you also diversify. So a process of radical diversification so that the cockroach is ready for anything the world might throw at it.
High inflation, low inflation, deflation.
Deflation, rapid economic growth, huge productivity, AI-driven productivity leading to massive gains in equities. Anything,
The cockroach is ready.
And cockroach is ready for that. So if there is a prolonged bull market in financial assets, the cockroach will do fine. It will do worse than the pure equity fund, but it will do fine. If there is massive deflation, it owns bonds, so it'll do fine. If there's massive inflation, it owns real assets and some alternative assets, and it will do fine.
Such as?
What
are the real and alternatives?
So how I diversify is I keep 25% in cash, 25% in bonds, 25% in equities, and 25% in what I call hard assets. Within the hard assets, at present, it's physical gold, own quite a chunk of physical gold, own some Bitcoin or cryptocurrencies, and a significant portion or allocation to what I call royalty businesses. Businesses that participate in the revenue generation of commodity businesses like mines and so on. So they don't have any capital expenditure. They just take a percentage of the revenue that a mine generates. And these are wonderful, high return on equity, low financial risk businesses, which are not represented in any index. So if you buy an index, you get zero exposure to these sort of businesses because they're generally not quite big businesses. So that's a significant portion of alternative real asset, a revenue share business, the royalty business.
To over trade in the idea of alternative here, so there is another alternative, which is to build a portfolio, first, that isn't constructed on the back of forecasts. I think you and I love that point.
Yeah.
Forecasting is a fool's errand. And that whereas the investment industry tries to evidence expertise by building portfolios made up of 23.7, 4.2, you've said 25, 25, 25, 25.
And rebalancing every 6 to 9 months.
And that resonates with Harry Markowitz, the father of modern portfolio theory. When he was asked in his retirement how he had built his portfolio, he said 50 equities, 50 bonds.
Yeah.
It's like just this naive or simple diversification, which is actually quite profound.
That's right. And I think if you put together different types of assets to react to different market environments differently, you get a very smooth outcome, a fairly smooth outcome, not perfectly smooth. You get a fairly smooth outcome, which keeps you in the game. And also, because you're not trading often and trying to eke out the next basis point of performance, as the consultants will want you to do, you keep your trading costs low. And that's another thing you can actually do in markets. You know, there's a couple of, most things you have no idea. You have no idea about forecasts. You don't know where GDP is going. You don't know where interest rates are going. You don't know where currencies are going. You have no idea. What you can do is stay in the market, stay invested. It's one positive thing you can do. And the other positive thing you can do is keep your costs down. And if you can do those two things, you are ahead of 99% of other investors.
And those are easily doable.
They're not hard. But the forces out there in the market, the advertisements, you know, you walk through the airport, you see all these guys advertising the latest fund and latest hot thing.
Try not to chuckle.
The consultants, the DFMs, they all try and force you to play the game they want you to play, which is a game of transacting.
And investing isn't a game, it's serious. This is my money, this is my future.
Exactly. Yeah. So that's where the intermediaries, financial intermediaries, make their money from transactions. And so you want to stay out of that process. That's an alternative way of investing.
That brings me to a question to you, Louisa, about trust. Because if investing is being traded as a game, to use Pete's word, and you arrive at the end of the game, there's no time machine that allows you to go back and say, well, this wasn't fair, this isn't what I imagined, and trust is broken.
Yeah. So, Adrian, it comes back to what the future of markets is going to look like. And unfortunately, in the past and in our current present, is we are incredibly reliant on that intermediary layer to verify, validate, and process the investments that we as individual investors want to be making in order to grow our wealth. So trust from the very beginning was embedded in the banks, the financial institutions that said, take my advice and you'll do well with your investments. But that's shifted. Markets have moved away from that hierarchical view of where trust sits to the actual enabling processes that is empowered by the tech. So once you take away all of the requirement for manual processing and sort of custody solutions and all of those things. We looked at it about a couple of years ago. There's around $200 billion per annum that is spent just on that intermediary layer between the investor and the issuer.
The form filling and
the custody and all of that kind of thing.
Wow.
And whereas what has happened is markets are shifting right now. And if you look at all the major global institutions, they are shifting onto the blockchain because it eliminates all of that complexity, the opacity, this gatekeepers who are stopping us from accessing the types of assets which we want to be investing in that are going to give us the returns. And that's where markets become networks as opposed to hierarchical sort of structures. And that's really exciting. And I think that so trust becomes almost it becomes a question that's no longer on the table when you've got a consistency of process where everything is, where assets have all of their rights, their legal, their commercial rights embedded in them. You don't have to have any gatekeeper managing that on your behalf.
Where's the document? Where's the papers?
Correct.
Proof of ownership,
Exactly.
etc. I under SV Capital can I buy the cow on the blockchain? Not just yet?
Not just yet, but we're definitely
Talk to
moving
us,
in
it's
that
Yeah, I
direction.
believe that this is an intervention.
Yes, thank you.
100%. But look, I think we're moving in that direction because it does speak to the element of trust, and it comes down to the accounting system or the process behind the actual investment. And for me, I think trust is more driven off the ability to execute rather than just saying, I need an institution to have been around for 100 years for them to prove to me that I can trust them. Because that's what we've seen from our end, that alternatives are introducing a new definition of what trust is when it comes to investments. And the biggest driver to that is, are you able to execute on my investment?
Yeah.
So bringing it down to the cattle, it looks at, if I'm giving you money to buy a herd, are you able to actually buy me a herd that's sitting on the farm, physically so? Are you able to make sure that all the additional costs are accounted for? Are you able to track that cow up until it's sold in order for me to get my return? And I think we're living in an age where investors want more simplicity in the process in order for them to feel like they can trust the process. For a very long time, trust has been driven off just having a brand and trusting that products coming from that brand. And alternatives are pushing a narrative or challenging that narrative to say that let's rather look at performance. Let's look at execution. Let's look at the underlying operation to then determine whether I can trust this investment or not. Because alternatives are now playing a role of diversification. And as much as historically there's been a very set split on what you should put your money in, now alternatives are challenging that split. They are asking for more, they're fighting for more of that piece of the pie, but it does need to come with validation of that model, but also the ability to execute on the processes around that asset to ensure that investors aren't losing their money.
Just give us a little bit of a tangible, practical sense. So you're describing the scooter, the motorcycle portfolio, the cow portfolio. What types of returns do I get from these investments?
So those investments are they're quite aggressive when it comes to their returns. So from a cattle perspective, you're looking at about a 14 to 16% return per annum. And with the delivery bikes, you're looking at close to about 20% over 18 months. So that comes down to about 16 to 18% per annum. And for us, these returns make sense because it links to the underlying operational business. So cattle specifically, for me, has been a sturdy return producer, just given the fact that the underlying business is a key part of the economy. You're playing within the agricultural sector, which means you as an investor are contributing to the agricultural sector and growing it through the deployment of your capital. Also, agriculture is the one sector where it's not allowed to fail. No matter how hard things get, it's the one sector that will continue. So there's a natural hedge around inflation. There's a natural hedge around interest. So those steady returns add to an investor's portfolio because we're not looking at just, shooting out the lights from a returns perspective, but we want to add consistency, predictability, and a solid return that can be there for an investor. With the delivery bikes, that's a more aggressive investment for us. because the returns are driven off the actual day-to-day execution of orders by these riders. So we essentially capacitate delivery riders in order for them to work for platforms such as Uber and Mr. D. So as much as the platform will require these riders to have the delivery bikes, 9 times out of 10, they won't have the capital to acquire that asset. And that's where we step in. So we essentially capacitate them to be able to execute on their job, and in doing that, you as an investor then participate in that execution. So they need to ensure they're doing deliveries, we earn a rental income on a weekly basis, and we then declare returns to our investors. So the return is there, but I love to say that, and you touched on this a bit earlier on, that forecasts are absolute nonsense, because the model only operates if the numbers are real, and the numbers become real once the execution really does come to life.
So if, just say a tiny bit more about this model. I rent a bike, do I eventually get to own it?
Correct. So how we've structured it is we rent a bike to delivery bike riders. As I mentioned, these riders would normally be contracted to platforms like Mr. D, Uber, in order for them to execute on deliveries, be it food or actual groceries or goods. So we would rent the bike to them over a set period, that being 18 months, on a rent-to-own contract. And the reason why we've done that, we did that purposefully so, is because at the end of the investment, we want to empower the riders. So we don't want to be greedy where we tie them into a contract and they're renting into perpetuity. Instead, the way we've structured it, we want them to rent for a set period of time, and when the term has come to an end, the rider essentially takes ownership of that delivery bike. And that means you've now created a micro enterprise within that rider, and they're able to either come back and rent another one, and they're renting their bike that they own to someone else, or you're empowering them to earn income continuously. So the business model in itself, we earn rental income on a weekly basis. So we already know what the rider earns. We already take over their account to ensure that we control the collections. And on a weekly basis, we collect those rentals. And essentially, that's how we recoup the investor's capital plus return.
Wow. So trust deficits are closed, impact is elevated. This is doing what capitalism is supposed to do, bringing dignity and inclusion.
Correct.
Or, if we want to drop our labeling, we can say what the economy is supposed to do.
Yes.
With impact and inclusion. That deserves like some... These people are tough this morning. Eh? It's like it'll be Tuesday soon. Pete, you've said no forecasting. Let me put one quick question to each of you, and then we'll open for discussion with the room. You've said no forecasting, but in this moment, what risks do you see in global markets? What's the biggest thing that could jump out the closet?
Yeah, so I think the biggest risk that investors need to be conscious of is probably the very high debt levels that the developed world, the Western world, is running at the moment, unsustainably high. And again, traditional portfolios are heavily weighted towards developed markets because they're safe and they're well run and they're financially responsible. So assets have migrated to these markets en masse. If you look at any index, they're heavily weighted towards these developed markets. So I think that's probably the biggest risk out there, some sort of significant credit event out of a market like France or the US, which then has knock-on effects into developed market bond markets and equity markets. So that, for me, that's a significant risk.
So you say, these developed markets are perceived to be well-run, safe, financially responsible. Those were the three descriptors you used. Well-run, highly questionable. Safe, well, that is always challenged in the fullness of time. And financially irresponsible would be...
I think that's a better descriptor. Yeah, exactly.
Yeah.
Yeah. If you look at the debt levels in places like, and not only debt levels, if you look at the political turmoil in places like France, Germany, the UK, the US, I mean, what happens to Africa? We are a stable part of the world, relatively speaking, to those political environments there. So, I think there's significant risks building up in places where people feel safe.
Yeah.
And there is a lot of safety in where people perceive there to be a lot of risk.
Which then again sort of demands this
Diversified approach.
Yeah.
Demands diversification. Because, I'm saying this is a risk, but it might not eventuate. Those central banks might continue printing money and, and continue kicking the can down the road for a very long time. So it might not eventuate, but if it does, you want to be like a cockroach.
No forecasting, but we do have to think about, what a future might look like. Let's imagine central banks decide that they will take just the financialization of debt. They're just going to print. How long could that go on for?
It goes on until it stops, and when it stops, nobody knows. But at some point, hyperinflations, like you had in Germany in the 30s and 40s, like you had in Argentina, like you have in Zimbabwe, they come to an end at some point.
Yeah.
But it's not clear when and how that happens, but it does happen.
And it's a bit like the way the turkey finds about Thanksgiving.
Yes, it's fine. You get fed every day for the 270 days leading up to Thanksgiving, and then on Thanksgiving Day, when you expect another bowl of food, you get an axe to the neck. That's how it ends, and the turkey just doesn't know what happened.
Okay.
So yeah. But I think what you're touching on is the most significant risk for any investor, and that is inflation.
Yeah.
And that is the risk you continuously need to deal with, because the goal of investing is to protect and grow your capital in real terms. In other words, to maintain and grow your purchasing power. That is what we do. That is what you do when you invest. You are maintaining and or growing the purchasing power of the capital that you have built up to that date. You're not competing against, I'm going to name some names, Coronation or Alan Gray, and doing better than Old Mutual and underperforming Sanlam. That's not what investing is about. Investing is about protecting and growing your capital in real terms.
I'll give you a tough one. Apologies for this. But you got the round of applause and you won the shoe prize.
How about the sock prize?
I don't have to. You certainly did.
Yeah, no sock prize for you. If there's a temptation to romanticize investing in cows and bikes and look at all of, but there are real dangers and risks in this. Won't you just share some of the things that we've got to be alive to?
Yeah.
What are the risks in your world?
Yeah, so you touch on something very important, because there is an element where we do romanticize alternatives, specifically the cattle investment. I'll speak from my perspective. And there's a risk in that, because we all need to understand that before we've turned these businesses into investment products, they're real businesses that operate on a day-to-day. And because you're investing in this, you're essentially attracting risks that are not financially linked. So the first biggest risk that needs to be taken into consideration is the operational risk. At the end of the day, because this product was a business prior to us turning it into an investment product, there are key operational risks that need to be taken into consideration. Is there a sound management team? Are there operational processes in place? Are there markets that you're able to sell these assets into? And that tends to be overlooked by investors because they're excited that I'm investing in cattle. But the investment in itself will not perform, because if those key things are not addressed or looked into, then naturally your investment won't perform. And as SV Capital, I mean, we've been fortunate enough to be on both ends of the spectrum, where in one end we worked with a farmer who was up and coming. And I remember when we started the business in 2017, we really had a big drive to empower emerging farmers, and specifically black farmers within the industry. And the reason in that is we wanted to grow with this farmer, give them the ability to hold more cattle on their farm, but also capacitate them to scale over time. And that quickly turned into a horrible situation. And that was mainly driven by the fact that operationally the processes weren't sound, the structures weren't sound, and also the farmer had not been at that level yet in order for them to validate their operational processes. Now we're on the other end of the spectrum, where we're working with an established farmer who's got years of experience, over 100 years of experience. They've got the technical skill and know-how and technology on the farm. Now that fundamentally changes our product, it stabilizes our product, and from an investor's perspective, it stabilizes returns, it makes returns predictable, and it also allows us to grow returns over the long term. And another risk that needs to be considered is the fact that the cattle investment has an element of being stuck in a certain region, and
Right.
localization has a natural impact on that product. So you taking a risk on the specific management team that's working on that farm and that area that that farm is in. So things like the weather, the management team skill set, where the feed costs are coming in and there's additional transportation costs linked to that. All of that now has a knock-on effect on the investment structure that we hold, because naturally our investment will absorb all these costs, which means our returns are reduced. So, you know, it's things like these that need to be considered over and above wanting to romanticize a product. There are real risks attached to this that investors need to be aware of and comfortable with before they want to embark on this journey.
I'm unconflicted here. I'm serious. You're laughing like it's not true. I'm unconflicted here. I don't have equity in any of these businesses, so I can speak transparently, unbiased. I watched your story very closely. I mean, we were in close conversation. And what Ayanda is understating is the incredible experience she went through and the robust process that has been built as a result of that. And what you did to look after your investors and to look after assets through that process is truly remarkable. It really is.
Thank you.
So, Louisa, if I could put the last question to you, is this a or B or an A and B outcome? Do you replace traditional, or does mesh sit alongside?
Adrian, it's a continuum, but ultimately the future of capital markets and the future of investing and trade is moving towards digital rails. So it's not about it's about including more people, giving more people access to assets that have always been gatekeeped by the institutions. And that's not just a moral ambition. You talk about ESG, you talk about including more investors. It's actually it's a structural advantage for the markets in general. The more people who have access, the more liquidity, the more value you create, the more of a virtuous cycle it is. So it becomes a feature of the system as opposed to little bits granted to very few. I think the important thing to know is it's not about will it be a digital bond or will it be a physical bond?
Yeah.
Because it's not about the wrapper. It's about the fact that if you migrate as we migrate onto digital rails, it's not an if, it's an as it's happening globally, what you do is you take all of the hard stuff off the table. You don't have to worry about governance. You don't have to worry about price transparency. You don't have to worry about liquidity, because those become features of the underlying infrastructure. Then you get time to really look at the quality of the businesses that are looking to raise capital from the market. You get access to really understand, to see, and to participate in a market that has been so inaccessible to most of us for far too long. And Africa, we have the ability to leapfrog because our market infrastructure isn't necessarily as evolved and as developed as the traditionally safe markets that Pete was talking about. So we have the ability to actually build the future while the rest of the world is migrating from the past into the future.
So what this digital does is it creates transparency, it creates granularity, it evidences ownership.
Correct.
It closes this trust gap. It creates symmetry in information.
Yes.
And so you're saying perhaps not an entirely digital world, but a world in which digital has a structural competitive advantage.
I believe everything's going to go that way. Can I give you one quick example of what traditionally is a really hard asset to take to market, which is a corporate bond, right? This is one of our issuers is a national private education group. Talk about impact. They work with kids in a mother tongue language to help them learn, because the science says it is a much more effective way of learning. And they were looking to grow their network. They needed to raise 100 million rand. To do that, they came to us. We helped them to structure a corporate bond. We helped them to submit the prospectus to SIPC, so it still had all of the underlying foundations of what a real-world bond would be, but it was natively built and issued on the blockchain. We helped them raise, they raised 100 million rand in 5 weeks. Wow. With a 17% retail market participation. Generally with a bond in the traditional markets, you need 1 million rand minimum buy-in to buy a note. Yeah. But with them, we made the minimum 5,000 rand. They were able to include the communities around the schools, the parents who were looking to invest and earn an income off their children's education. And the beauty of this asset, Adrian, because it is active and it is visible to the audience, is we're seeing somewhere between a 12 to 15% annual liquidity on this asset, which means people are continuously, they're getting their quarterly coupons all paid out through Mesh, because we have become the infrastructure, the lifecycle manager of that asset, and all of the calculations around interest and who's on the asset register, who needs to be paid what. We do that on a quarterly basis. People, 50% are reinvesting their quarterly coupons back into the same asset, and about 20 to 30% into other assets on the platform, because you make things easy to access, you make things simple to use and transparent. Investors will see the value and will engage and adopt. I mean, in a 10-year bond, you do not see liquidity of that kind, of that
or
secondary
17%
markets.
Retail participation.
Yeah, exactly.
Yeah.
Exactly.
Let's do some questions. You're talking about digital. You remind me of a business that I've got to know very well. There's a fantastic book out on a digital bank called It's About Time. And the cost of looking after a customer in a traditional bank is $170 per annum, if you think of all of the headline banks, and the cost of them looking after a customer is $7 per annum.
Yes.
And this is the model that you've got.
Exactly.